Hey guys, this is Justin. On April 30th, we interviewed 24 guests in a 12-hour live stream to raise money for Susan G. Komen in conjunction with our friends at Spot Gamma. Our guests were some of the smartest market experts we know, covering topics ranging from value investing to factor investing to macro and options. We are releasing each of the interviews in pairs of 2 over the week following the live stream to bring our guests' insights to our audience in shorter videos and to continue to raise money for a great cause. If you are able to, we encourage you to donate using the link provided alongside each video. As always, thank you for listening. Please enjoy our conversations with Joseph Wang and Cullen Roche.
Hey, Joseph, how you doing? Thanks for joining us.
Hey, Brent. Hey, Jake. Nice to meet you guys. Congratulations on a successful live stream. You got an all-star panel. It's my honor and pleasure to join you all.
Thanks so much. We're super excited to have you. Super excited that you were willing to come up here and anchor us later in the day. And obviously, to have you, Mr. Fed guy, right before the Fed is super exciting for us. So if you could just start quickly, I'm sure, again, like most of our other guests, everybody knows who you are, but just in case, let's give them a little background.
Sure. So as you guys know, my name is Joseph Wang, and right now I run a research service called fedguy.com, where I teach people how to understand markets and write about the Fed. Before I started doing this, and of course, I also have a really nice book called Central Banking 101 that is a bestseller on Amazon in its category. So before I did this, I was a trader on the open markets desk at the Fed. And what that means
Let's bring
is...
my copy up as well.
Oh, thank you.
Nice.
Very flattered, very flattered. So being on the open markets desk, what you are is basically you're the team that goes and executes transactions on behalf of the Fed. And you are also the point of contact between the Fed and the market. So what we would do is we would talk to all sorts of market participants, from banks to hedge funds to foreign central banks and so forth, figure out what's happening in the markets, look at our data, write reports and things like that. So it's a really good experience in terms of learning how the market works, how the Fed works. And before that, I was a lawyer and a credit analyst and some other consulting jobs, but that's on a past life.
Yeah, so everyone, when we hear about the Fed, everybody pays attention to what's going to go on, the meetings and interest rate changes and potential for interest rate changes and stuff like that. But I know the Fed does a lot more than that. So I'm wondering, just to start, if you could talk about like what the primary roles of the Fed are.
Yeah, so the Fed right now, it's really changed a lot over the past, say, over 100 or so years. So at the beginning, as we all know, the Fed is really just a central bank acting as lender of last resort, right? So in the case any bank has some need for liquidity, they go and can get an emergency loan from the Fed so that their depositors don't panic. But over the past 100 years, the Fed has really grown its role significantly. So in the 1970s or 80s, you added the price stability for unemployment mandates. But now you also have all these other things, such as trying to maintain financial stability and increasing its role as a banking regulator. One of the ways you can see this is how the Fed has expanded its role through every crisis. Now, beginning, the Fed was just lender of last resort to the commercial banks. But if you think back at 2008, during the financial crisis, the Fed became the lender of last resort to not just domestic banks, but foreign banks as well, through the FX swap facility, money market funds, through special facilities, primary dealers, through all sorts of dealer facilities. So they're basically extending their footprint to being the lender of last resort to even more entities in the financial markets. Now, fast forward again to 2020, the Fed rolled out these new facilities to lend to corporations, so it's corporate credit facility, and even tried to be the lender of last resort to more mom and pop enterprises through its mainstream lending facilities. So you have a Fed who's basically growing steadily and having a greater role as lender of last resort, basically to everyone in the financial sector. And in addition to that, they're becoming more involved in how I think banks operate through the amount of regulations that are being rolled out. So you're thinking back to 2008, banks actually were quite lightly regulated. And so they were free to make all sorts of loans, lever it up and so forth. They were often a source of instability in the financial sector. But now, after a lot more regulation and after the Fed has a lot more power over them, you can see that, for example, in 2020, the banking system was totally fine. They're a lot more constrained. And so I think the Fed's role today is it's just a lot bigger than it used to be. And it's actually why so many people spend so much time watching the Fed, because what the Fed does, whether or not to hike rates, lower rates, what they do with their balance sheet, really has a huge impact on assets, not just in the US, but throughout the world. I think a really easy strategy would have been over the past decade to just buy when the Fed is easing, sell when the Fed is tightening, and you would have done quite well. Everything seems to have been very much Fed focused. But I think that's changing right now, though, as we see more and more emphasis has been put on what the fiscal authorities do, be it Congress or be it the U.S. Treasury. And so we may be at the apex of Fed power right now.
I know you're on Twitter regularly, so you're exposed to people like me who think they know a lot about the Fed, but don't actually know a lot about the Fed. And I'm wondering, like, what do you think the biggest misconception for like your average investor out there is about the Fed?
Well, I think there's a lot of misconceptions. I remember over the past few years, that people were always adamant that the Fed is there buying equities, you have a plunge protection team and so forth. Or maybe the Fed has some kind of playing 3D chess, doing some kind of complicated thinking. My experience at the Fed is a lot more post office than bank. So the people there, nice people trying to do a good job. But, I think it's a lot simpler than people make it out to be. And I think what they say is largely what they think. And also, to the best of my understanding, the Fed does not buy equities.
Do they care on that point, though? Do they care? A lot of people will say the Fed does care a lot about where the equity market is. Like that's something that plays a role in their policy. Do you think that's accurate?
I think that is accurate. And I look at it in a couple of ways. So one of the Fed's mandates is financial stability, and the equity market is a big part of the financial system. It shapes perceptions that people see the equity market is tanking. That bleeds into other assets as well. And I think that is one aspect. The other aspect, the other aspect is when you think about full employment as one of their mandates, a lot of the U.S. economy, I think, is in some relation related to equity prices. For example, if you look at the tech sector, what they do is they pay their employees in tech stock, right? So the higher the tech stock are, basically the more money they're able to print by issuing shares. And so that directly impacts things like employment and also impacts things like investment, right? Right now, all the tech stocks, they're spending a lot of money buying stuff, doing capital expenditures and buying stuff related to AI, like NVIDIA chips. So there is that angle too. And the US is traditionally, I think, so every country has a different favorite asset. In Canada, it would be real estate, in China as well. But in the US, it's a stock market. So I think it has an impact on consumer sentiment. So when you have it fall too much, I think it does impact the overall sentiment, which does bleed into their other mandates. And lastly, the truth is the Fed are comprised largely of government employees. Many of them who in decision-related making roles have spent their entire careers in the Fed. So, their retirement is basically in the stock market. Now, nobody likes to see the stock market fall as we approach retirement, right? Everyone, when you're approaching retirement, would like to dream of, getting that yacht and sailing out into the sea. The difference is that if you are a senior person at the Fed, you can actually do something about it. So in my experience, we brief senior policymakers in Washington all the time. I've never really heard them concerned about anything until they see the stock market drop a lot. then like, is there anything we can do about this? So there is some self-interest there. It's kind of, it is kind of a conflict of interest, right? So you have an organization of people who make big decisions that impact the stock market, but they're also heavily invested in it themselves. It's a human thing, I think.
I think on that theme, there was a little mini bubble was burst, I think, yesterday with the Treasury refunding announcement with people assuming that there would be, that the data would support this idea that, hey, we're going into an election. And so we're going to have policies that are accommodative to the election. And that idea seemed to be kind of zapped yesterday. Do you think that there is any kind of a policy adjustment or I'm trying to think of what the right way to phrase it is, but there's kinder policies or supportive forces at play into an election if there's a kind of an incumbent running?
Yeah, so I think that's already been done by the Treasury a few refunding statements ago. So as we all know, the Treasury quarterly refunding announcement has been a point of focus for the market. It's during those announcements where the Treasury tells the public how much debt it's going to issue, and more importantly, its composition. The thinking is that if you issue a lot more longer duration debt, it's going to put upward pressure on longer dated yields, and that would be negative for risk assets. Whereas if you issue more short dated stuff like bills, that's going to be pretty market neutral because right now there's a lot of demand for bills in the money markets. Now, the Treasury's self-imposed guidelines are to have about 20% of its debt in bills and the balance in coupons. Now, over the past 2 quarterly refunding announcements, they've basically expressed a willingness to significantly deviate from that, and they've been doing that. So right now, bills are more than 20%, I think 23% of something like 23% of the overall outstanding Treasury. So they are deviating from their from their guidance, and that is providing some support for duration. All things equal, putting a bit more downward pressure on longer dated yields. Now, I think that is their move to be more accommodative, because if you look at, so the way the Treasury looks at this would be standard models like the term premium model. The term premium is quite low, so there's really no reason why you couldn't just maintain your self-guided 20% portion of bills and issue more longer dated duration coupons. So that's that seems to me to be their effort to try to bring some stability in the Treasury market. Remember, the last quarter of last year, we did see 10-year yield go up to 5%, and there's a lot of panic there. So I do think that's already there. I don't think it's going to make a big difference this week. What they've done is they've already laid their cards out. They're saying that, we are going to have coupon sizes, basically stay the way they are for about, let's say, the next year. And so I don't expect the QR rate to have a big impact on markets simply because they've laid their cards out already.
What is your take on where we are with inflation right now? I mean, inflation seemed to be coming down pretty well. We've had a little bit of the last few reports haven't been great. What is your overall outlook, and where do you think we are with inflation?
So inflation, I think, has been a big problem for the Fed. So look at it from their perspective. Their target is PCE, right? Now, for the last 6 months of 2023, it was bang on at 2%. So at the end of last year, the Fed was feeling pretty good. But then when we come to the first quarter of this year, it looks like inflation was not really going to stay at 2%. Right now, it looks like it's about 3%. And it's a volatile series. So my view is that it's really difficult for the Fed to get their target back to 2%. Simply because of all the fiscal spending that's happening. So, this is kind of a strange thing that I see right now. And it's really a big issue for the Fed because they're given the mandate to have stable prices, but they don't actually have the tools to do that. Now, if you look at the annual reports of the Federal Reserve from the 1940s, they'll tell you that, getting inflation under control, part of it is credit policy, part of it is interest rates. But, that's just one part of it. You got fiscal spending, you got maybe price controls. It's a whole of government approach. It's really not so simple. I move something in interest rates and inflation goes back down. That's actually really silly and has never been true. But the thing is, that's the only tool the Fed has, and they have a mandate, and they're the one that has responsibility. So on the one hand, they're keeping interest rates at around 5.5%. But on the other hand, the Treasury keeps creating dollars and spending it through deficit spending. And the expectation right now, and this problem was become so much of a highlight. There's actually a section in the latest IMF report on it. And the IMF is projecting a 6% fiscal deficit for the U.S. for the foreseeable future. Now, if the U.S. is deficit spending at 6% a year, inflation is not going to go back to 2%. That's really difficult, even as the Fed toggles interest rates, because you're just basically printing so much treasuries. Now, one way to think about this is treasuries are dollars, right? Treasuries is a liability of the U.S. government, U.S. dollars, credit risk-free, very liquid. When you're deficit spending, you are printing dollars. You are basically depreciating the currency. And when you do that, it's hard to get inflation under control. Now, the Fed could go super extreme, hike interest rates to 10, 15%, but then they push against their other mandate. So at this point, I don't think that inflation is going to go back down to 2%. I think maybe 3% where we are, it makes sense until sentiment changes.
Is there a case to be made that that's okay? I know 2% is the target, and I'm not smart enough to understand why 2% is the target, but is there a case to be made that allowing it to remain at 3%? It's obviously not the 5, 6 it was before, that's okay as an economic outcome?
Yeah, totally. So, just a little bit of history. The Fed rolled out its 2% target. Well, actually, they internally thought of it as 2% in the Greenspan era, but didn't officially announce it in 2012. Now, if you look at there's some research looking at the past Fed discussions and minutes on this, and what they found is it was really hard to get consensus for 2%. It was hard because some people wanted 1.5, some people wanted maybe a range and not a target. And more importantly, the personnel on the FOMC was changing throughout time. So it basically took a decade-long process to get the right people at the time to agree to 2%. Now, look at what we have today. The composition of the FOMC has changed significantly. President Biden made a lot of appointments. And if you look at the CVs of those guys, they basically don't have any experience in monetary policy, I think, except Jefferson. Everyone else is basically a labor economist. So you can see that the composition of the people there are changing towards maybe more pro-labor. Now, to the extent that you think there's a trade-off between inflation and unemployment, you're getting an FOMC that is going to weigh employment more heavily than inflation. So I think, we can easily make an argument that they could accept that, hey, why don't we just have 3% inflation and, make sure the unemployment rate is as low as we can there. So I think that's totally reasonable outcome for the future. And we already hear very important people in the policymaking circles like Jason Furman writing op-eds in the Wall Street Journal, suggesting that we could just, raise the target a little bit, right? So why do we have to raise unemployment just to squeeze out that little bit more of inflation?
I'm just curious when I look at the Fed meetings, I look at the high level, when they announce what they're doing with rates, like someone like you who's been inside the Federal Reserve, when they announce what they're going to announce tomorrow and there's the press conference, like what are the most important things you're paying attention to when you look at what they do tomorrow?
Yeah, so it's going to depend on the context, right? So, okay, so tomorrow's not a dot plot place. If there was a dot plot, I would place a lot of emphasis on the dot plot, just where the distribution of the dots are and so forth. But for tomorrow's meeting, this is what I'm most interested in. So, as we all know, heading into this meeting, inflation has been higher than expected, and the Fed has a dual mandate, both stable prices and full employment. Now, we know that they're not doing that well on their inflation mandate, and Chair Powell has already warned us during a meeting he had with Governor Tiff Macklem of the Bank of Canada. He basically made it a point to tell everyone that he was not happy with progress on inflation, so he was being more hawkish, and that's going to be reflected in the discussion he's going to have tomorrow. Now, what I'm interested in, though, is how he's thinking about employment. The reason that I think about this is that we had a recent GDP print. Again, on the headlines, it was 1.6% quarterly growth, far below expectations and far below the potential growth of the U.S. economy. But on the other hand, the economists who study this note that a lot of this is just more volatile aspects like net exports that are making the print look worse than it actually is. When you look at the underlying core, let's say private final demand, it seems like it's quite good. So at this point, I'm curious to see if the Fed is going to put more emphasis on the weaker headline, 1.6, and that would give them a reason to argue for, maybe a little bit more dovish policy, because at that point, although inflation is still high, you're getting a bit more concerned about your employment mandate because growth is slowing. Or are they going to take the other route and just look past the headline and look at this, just the core underlying private final demand and say this is still strong, so I'm going to push forward on what the market is pricing, which is maybe just one cut this year. So this, I think, how they interpret this GDP print is what I'm going to be most interested in. Now, the second thing that I'm most interested in is that we've had tremendous changes in the labor market here in the U.S. So one of the big things that's happening now, we've seen huge employment prints, right? Last month it was 300,000. How does that make sense? It makes sense because there's just been millions and millions of people entering this country. Consumption data stronger than you would think, and also employment data stronger than you think. Because you have all these people, millions of people here now working, now buying stuff. now demanding paying rent, for example. So it's kind of screwing everything up. And I want to see how the Fed is, if the Fed has any more additional thoughts, how that's going to impact how they shape monetary policy.
Just one last one before we wrap up here, or actually a couple last ones before we wrap up. What is your thoughts on, if the Fed can stick a soft landing here? I mean, it doesn't seem like, a lot of the macro people we've had on today think it's very unlikely that's going to happen. We've had people in the higher for longer camp. We've had people who think, we're headed for a recession soon. I'm just wondering, like, what is your take on that?
So I think that right now what we are in is basically just a crack, what people would classically call a crack up boom. And that's because the fiscal side, the amount of fiscal spending is overwhelming everything else. So landing or not landing, I think what would happen is that we just continue the way that we are, and maybe inflation stays around where we are. But eventually, though, what we have, and we have many instances in history when we have this happen, we have tremendous amounts of fiscal skimming, economy goes well, everyone is happy, everyone thinks. But ultimately, though, people have trouble coordinating among themselves because inflation and prices become more and more unstable as money continues to be printed and spent. And we do get into a recession. But we get into a recession where nominal prices don't actually decrease, nominal GDP continues to increase. So you will have slow growth and higher inflation. Not necessarily negative growth, but just kind of a very slow growth and higher inflation. So I don't think that's either a soft landing or a hard landing. I think it's kind of more of a malaise. And I think that's kind of a very common route for what we see in countries who just kind of have very badly managed fiscal policies.
So as we wrap up, we have one closing question we've been asking everybody today, which is, what's one interesting thing you're seeing right now that you think other people should be paying more attention to? And it can be inside investing or outside investing. It can be anywhere.
Yeah, so I think gold is really worth paying attention to. So at a high level, I think that macro is downstream from politics and culture. And we have very big political realignments happening in the world. Now, if you're a traditional macro investor, you're looking at gold through the lens of, let's say, dollar strength or real interest rates. Now, the dollar has been strong, real interest rates have been high, but gold has been surging. Now, you can think it has to do with geopolitics, but we have all those geopolitical situations, kind of quieting down right now. It looks like what's happening in the Ukraine war is, honestly, from what I hear from people who study this, it's kind of over. And it seems like there's kind of at least a temporary détente in the Middle East. But yet gold is still around $2,300. So my sense is that just for the same reason that the U.S. is frantically building chip factories in Texas and Arizona, right? They want to diversify their supply chains. They want to manage the counterparty risk with countries like China. And so countries like China have to manage their counterparty risks with the U.S. But of course, they're not going to be building chip factories. That's not what they're reliant upon. Their vulnerabilities have to do with their exposure in the financial system. And I think this is something that it's going to be a sustained phenomenon. And I think that means that, gold is going to be well supported. And I think it can go much higher than anyone thinks, simply because there's a lot of dollars that need to be diversified. And that market is just not very big.
Well, thank you so much for joining us. We really appreciate you coming out and helping us support Susan G. Komen today. And we really appreciate your time.
Thanks so much for having me. This is a fantastic panel, and I look forward to watching all the episodes tomorrow.
Awesome. Thanks so much,
Thank
Joseph.
you.
Great talking to you.
Cullen, what's up?
Hey guys,
Can you hear us?
how are you?
We're doing all right. We're operating on a little bit of fumes
I
here.
can hear
We've
you.
been
Can you
going,
hear me?
Yeah, we're doing good. We've been, well, what are we at 9 hours now, Brent? Of,
I think,
or 10 hours now.
yeah, somewhere in that realm. Yeah.
So you're going to interview yourself at this
You
point.
guys are nuts.
We've run out of gas in the tank, but we're really excited to have you. We're really excited to get your insights on everything. And we're actually gonna do something very cool with you because you've built your own little macro dashboard here. And so I'm gonna share my screen and or you can either way, and we're gonna dig through that and a lot of the charts you have on there will kind of get us into some of the issues that are going on in the macro
Hopefully
environment.
make your job easy. You
Yeah.
guys can take a nap. Take a
Yeah,
nap.
exactly. But it's nothing again. If we're sleeping,
It'd probably be a higher quality. Yeah.
Yeah, nothing
We
against
don't
you
ask
if we're
questions,
sleeping
we better.
during the interview. But before we start, we just want to remind everybody why we're here. We're here to support Susan G. Komen. If you're watching us on YouTube, there's a donate button next to the video. Please donate if you can. If you're watching us on Twitter or on LinkedIn, you can go to YouTube and the donate button will be there. If you've gotten any value out of what we've done today, we'd really appreciate it if you could donate whatever you can. So having said that, let me, I can share my screen here and bring up your
Amazing cause, by the way, guys. I don't want to be morbid, but somebody very close to me just was diagnosed with leukemia, and it kind of brings all of this front and center and how important. We'd spend a lot of time thinking about money and stuff, but for me, being not just a portfolio manager but also a financial advisor, really brings front and center how important estate planning is. A lot of people, I can't tell you how many times I've run into situations where an estate hasn't been properly planned in advance, and something like this happens that is totally unexpected and is hugely traumatic for everyone involved, but especially for the people who have to deal with the succession planning. So, it's not only important to contribute to causes like this, but it's also important to accept the reality that this is something that impacts millions and millions of people. And, you just can never plan exactly for something like this. So being forward thinking about something like this is hugely important in terms of, not just the way you plan for your investment portfolio, but the way you prepare for your entire estate planning situation going forward.
Yeah, that's a really good point. Pretty much all of us have been touched by cancer in some way or another. And it's such a great cause. With your point also, yeah, but planning for these types of things is so important as well. And that's something that, like, you as a financial planner and a lot of other financial planners add a lot of value in. So we wanted to start. First of all, I'm very excited here that you actually have your own recession rule. That's something I've really wanted to have for a long time. I don't know how you get that. There's like an application process where you go through and get your rule approved by the recession board or something. But you have a very cool chart here of the Roche recession rule, and so I'm wondering if you could maybe explain what we're seeing here, and what it's indicating.
You just to get your own recession rule, you need a one-person board of trustees who approves the rule and then names it after themselves. So in that case, I am the singular member of the board of trustees of the Roche recession rule, and determined that this was a sufficient rule to be named after myself.
I assume it's like the yield curve conversion. It's 100% successful as well in predicting recessions.
Oh God, the yield curve.
Maybe we should get into that.
Yeah. So anyways, this is basic. I mean, all recession rules will be virtually coincident indicators. So, there's very few things that are ever going to actually tell you when a recession is coming, in large part because a lot of the data that ends up confirming a recession ends up getting revised so many times over the course of the periods over which they actually roll out this data, that by the time it actually confirms a recession, the things that are important, like for instance, the stock market, will have probably already reacted to things like this. But anyways, it's kind of useful. This was weirdly sort of useful last year, actually, when a lot of people were declaring that a recession was inevitable, and a lot of even coincident indicators never said anything like that was coming. The one that I've always relied on the most was jobless claims. When you look at the 4-week moving average of jobless claims, for instance, it sort of budged higher at points last year, but never really reached a point where it was confirming a recession. There's certainly not like a huge deterioration in the labor market. And that's one of the main criteria that goes into the way that the NBER, the National Bureau of Economic Research, actually determines whether a recession is going to come. So I like using, looking at a lot of different indicators. So keeping this one sort of simple, I use what's called the long-term unemployed rate, which is basically the percent of people that have been unemployed 15 weeks or longer. You can combine that with unemployment claims, and you get something that when you actually back this out, the screwy thing with all of our charts now on, especially Fred and any data, is that COVID ruined them all. So like this chart, you basically, you can slide the scale underneath to actually look at when the recessions are relative to when this reading actually goes over 50%. But it basically is always right. So whenever you actually see the combination of these two metrics moving over 50% year over year, we're already in a recession. And so if you look at this last year, we got sort of close, close-ish, but never really got to a point where this was indicative of a recession. And so, my working theory for really the entirety of COVID has basically been that we're mean reverting back into sort of the pre-COVID style economy, that as supply chains sort of normalize, and even things like the budget deficit normalize, government spending normalizes, you'll see everything sort of moderate back into a lot of the trends that we were all sort of accustomed to in the pre-COVID environment. And so we're still working through all that. So we've digested this huge amount of stimulus. We're still digesting it. We're digesting huge supply chain shocks. And that process, as everybody kind of knows now, it's just taking a lot longer than expected. And, it's taking a lot longer than the Fed expected, certainly taking a lot longer than people like Team Transitory expected. So, but at the same time, the process is still very much in the works, I think. And so we're still in this process of sort of mean reverting back to the pre-COVID environment.
So the second chart kind of gets at this idea of what people are hoping will happen if we migrate back to the pre-COVID environment, which is that inflation will go back down to 2%. And when you look at it in this context, it has gone down, but some of these recent prints have not been great. People are seeing a resurgence in inflation. What's your take on where we are right now with inflation?
Yeah, well, it's weird. Inflation came down a lot faster last year than I think most people expected it to. And so I think a lot of the first, especially the initial months of this year are sort of a little bit of like give back from that the rate came down so fast, and then expectations kind of got out of whack there, that people, I think, were expecting that trajectory to continue. And now we're seeing that, one of the common narratives last year was that the last mile was going to be the hardest mile. And we're seeing that's true. It's a lot harder for inflation to come down, to be cut in half from 6 to 3% than it is to go from 3 to 1.5%. And so we're in the midst of that sort of last mile here. A lot of people are worried about a sort of flare up of inflation, or the potential for, like a sort of a 1970s or 1940 style double bump in inflation. I don't see it. I just don't see where it's going to come from. I think you'd have to get either another big spending package, or maybe, I guess the most probable cause of something like that maybe would be oil prices. If oil prices went to sort of that was really what happened in the 1970s, was you had just this nonstop oil price boom, where oil prices went up, basically relentlessly for 10 years. And, it was more complex than that, but oil prices, especially with the economy being so oil sensitive back then, that was the primary driver of inflation back then. And so you'd need oil prices, though, in the equivalent world, you'd need oil prices to go to like $300-400 to cause something that looked really similar to the 1970s, where we got another flare up where core PCE inflation goes back to like 5, 6, 7%, really, really high levels. So, could that happen? I guess. Yeah, sure. Certainly if, tensions flare up in the Middle East further, that would be a catalyst for it. But, I think the baseline assumption right now is that that's not happening. Global demand is not strong enough to drive oil prices that way alone. So you'd need some sort of really unusual supply side shock to cause something like that. So I still think, we're going to get to the Fed's target. And it's a question now of, are we going to get there through the Fed, really keeping their foot on the brake of the economy through high interest rates? Or do we actually just continue to sort of ease into that 2%, just through slowing demand that gradually eases us back there? So looks like the latter's probably the more likely scenario, but there's still that outside risk that, a lot of people think that, we talk about the long and variable lags of monetary policy, and a lot of people think that, a lot of people are even saying Fed policy is broken now, which again, I don't see. I think that the Fed seems to be doing a much, much better job than anybody expected them to. And the last few months have been sort of, a little worrisome, but, I think the baseline trajectory is still there, that we're headed to 2%, probably some point in 2025. And now it's a question of, do we get there in this nice sort of, soft landing scenario, or do we get there in more of a bumpy scenario where, we kind of maybe in 2025, 2026, we look back and we say, maybe the Fed was a little too tight for too long.
Do you have an opinion on which one of those two we might get? Do you think there's a chance they could stick a soft landing here?
I mean, it's not the historical norm for them to, they tend to be so reactive. I mean, betting on recessions is usually a bad bet. But my baseline view here basically is that the economy is soft, and that makes the potential for turbulence higher than usual, just because especially when you look outside of the United States, I mean, everywhere else looks really, really soft. I mean, the economies in Europe, China, the UK, I mean, virtually Canada, you look at everyone else who has raised rates pretty sharply, they all are following a much more textbook sort of scenario where growth is slowing very quickly. They're having asset prices and borrowing that is slowing very rapidly. The US has been a lot stronger for a lot of different reasons, but I think that the broader sort of aggregate global story is telling a more accurate story in terms of what's going on and how effective the rate hikes have been. It certainly worries me. The longer they continue to keep rates at like a very high level that looks overly tight, I think it's almost irresponsible not to consider the risk that they're making a mistake of being too tight for too long.
So this next chart, you have the misery index here, which sounds pretty painful. What are we seeing with this?
Yeah, so this is a common metric of, really, sentiment is generally the thing that it tries to measure, and it measures unemployment plus the rate of inflation. So typically when this is very high, it's indicative of sort of like, if you look at the 1970s period, that was a classic stagflation where you had very high unemployment and you had very high inflation. It's actually a super interesting environment because people are really pissed off about the economy. And when you look at a lot of the underlying data, like, simple metrics like the unemployment rate and inflation, things don't look very bad at all. So there seems to be, there's a lot of debate about this especially on Twitter and in the media about, a lot of this seems to just depend on which political party you're in, whichever guy you're rooting for in the next election seems to be the one that, kind of drives the narrative here. But, again, I think this is COVID has been such a strange environment. I think that I try to put myself in other people's shoes in a lot of situations. And I always try to consider the people who, say you make a median income, say you've been really prudent over the course of the last 5 years. COVID happens. The government blasts all this money into the economy. Home prices go up by 50%. Wages are kind of just keeping up. And you feel like you've done everything right financially. And all of a sudden, you have to sort of adopt the reality that, like, you might rent your house, or you might be a renter for the rest of your life because home prices have just run away. There's all sorts of scenarios like that and there's tens of millions of people like that who feel like they're either people who are locked in their current home or people who are locked into renting and being forced to accept higher perpetual rental rates going forward. And those people are really mad. They feel like the stimulus that, we spent $7 trillion over the course of COVID. And I think a lot of people look at the COVID stimulus and they say, what did this do for me? And I think it's hard to judge the counterfactual, because the counterfactual was probably like a horrific recession that, would have been even more traumatic, but people still objectively look at the current environment and they say, we spent all this money, and what did it do for us other than, make everything really expensive? So it's almost like there's a lot of misery, despite indices like the misery index actually saying there shouldn't be a lot of misery.
It seems to be a common theme here. People are just pissed off, just about whatever. It's a theme that sort of popped up a couple of times here, I think, today.
Yeah, I mean that's what makes the financial markets great, right? Like, I mean, 50% of the people are probably going to be pissed off about something they've done because they're either in the right trades or they've gotten out of the right trades.
It's also the joy of price. There's some truth in price. You can be angry about it
Yeah.
or not, but it is what it trades for.
Can you talk about this next one, the Taylor rule? This is something you heard a lot when inflation spiked a lot because people use it as an argument that rates had to come up a ton. But can you talk about what the Taylor rule is?
Yeah, so this is a metric by economist John Taylor, and he basically tried to create a systematic rule by which the Fed would be able to determine what the overnight interest rate should be in more of a systematic way. And I think that, I've always liked the idea. I can't, the Taylor rule's got plenty of problems, and, like I would argue that its variance tends to be much wider than, like should the Fed funds rate have gone to, what does it say, 12% in, 2022? Probably not. You probably would have, you would have crushed everything in the whole economy if they'd done that as quickly as the rule said. But at the same time, I think there's a lot to be said for having systematic rule, not just in terms of monetary policy, but especially, in portfolio management and anything that involved the behavior and the management of especially like lagging data, like we tend to get with a lot of economic data. And what we tend to often find, especially with Fed policy, is that they tend to lag so badly with a lot of this because they're reactive to the data that it's not unusual for the FOMC and the Federal Reserve to make policy mistakes, just by nature, just by the way that they are sort of, with a lot of discretion navigating the interest rate environment. And so I've always loved the idea of a systematic rule. And this rule is just trying to measure where potential GDP is relative to inflation and where the overnight rate potentially should be, to try to really measure whether the economy is hotter than it should be. And so, this one was especially interesting back in 2021 because, a lot of us were saying, hey, there's, I think people, especially in finance, with everything that was going on back then, were very aware that things were screwy. Things were arguably way out of control. And the Fed weirdly was sort of sitting on their hands and saying, there's no reason to overreact to this because it's all going to be transitory and supply side driven. And it actually looked like, especially from the financial market side, that a lot of the craziness was demand side driven. People just sitting at home, with too much money to spend and doing, outlandish things. And the Taylor rule was way, way ahead of the curve on this. And so, the rule is interesting now because we finally, in the last sort of like quarter or two, got to a point where the Taylor rule says that monetary policy is sufficiently tight. So this will be interesting going forward because we're kind of in that period now where we're seeing whether monetary policy really has these long and variable lags. And we're going to find out in the next 6 to 12 months whether the Fed is too tight now or if they kind of just have things exactly right.
How about this? This next one is average hourly earnings. And this kind of paints a little bit of a different picture of what's going on than what I've seen in some other charts. So can you talk about why you think that's important?
Yeah, this has been one of the narratives where people have said that monetary policy hasn't worked. They've looked at the labor market and they've said, hey, the labor market is still strong. And that means that the Fed funds rate is having no impact. But when you actually look at things like average hourly earnings, well, you can see it's come down pretty sharply. And this is sort of consistent with the whole inflation narrative too, that wages have come down a lot. So, we're a little over 4%, where we've come down from, 7% or so. So we've made good progress in terms of bringing down wages and bringing down the rate of inflation, but it's just taking longer than expected. Things are a little stickier than a lot of people expected them to be. So it tells the same basic story, though. I think that, I'd be shocked if average hourly earnings don't mean revert back to, say, something more like 3.5% by the end of this year, certainly by 2025. But the macro economy is just this huge, slow moving beast. And I think that, a lot of us get so impatient with all the things that are going on because we look at all this stuff every single day. It's easy to forget, hey, this is a, a $30 trillion economy. It moves, like a big lumbering beast at this point. It's not this nimble little, ship that moves around quickly by any means. So it takes a long time for these trends to play out. So again, I think the average hourly earnings are consistent with the sort of inflation story, that the trend is in the right direction. And it's just trending a lot slower than a lot of us would hope.
Okay, Brent.
Can I ask a question on that topic, Colin? And I don't want to politicize or anything, but is there an immigration side of this as well? I mean, it seemed like there was some legitimate comments about that, and feel free to say a stupid question. Let's move along to that one. But I was just curious your take on that.
No, I mean, I think that I think it's fair to at least, is it the dominant driving factor in wages? No. Is it an impactful one? Yes. And I think that that's, it's fair also to look at, like I've been kind of critical of the deficit we've been running over the course of the last 18 months. Like I say this all the time now, but if I was running the Fed and I saw the deficits that were being run, I would be furious. I'd march over to Congress, the White House and Treasury, and I'd be like, guys, you have an inflation problem. You want to win elections? Bring inflation down. That's what people are pissed off about. And so it's sort of strange that we call it fiscal offset, but the thing is, or monetary policy offset or fiscal offset, depending on which side of the coin you're looking at. But during a high inflation, you should not have fiscal offset where the Fed is trying to bring down inflation and the Congress and Treasury are continuing to run huge deficits that basically counteract a lot of what that's doing. So, yeah, I mean, I think it's fair to be political in this environment because inflation has been the dominant theme, and inflation's not coming down fast enough, in large part because we've enacted some pretty silly policies that are not targeted towards helping inflation come down.
It's interesting. Like if you were on that point about the election, if you were in previous elections, if you could argue that everybody's in cahoots, the Fed and the government, and they want to juice, do whatever they can to get elected, what to do was obvious before when there was no inflation. Like obviously you juice the economy, you go, but now it's maybe a little bit more questionable. Like even if they wanted to do that, what would they do? Because there is an inflationary price to pay for what they're doing. And, inflation, obviously, oil prices, all that stuff, it's not great for your average person. So, there's some debate, even if they were going to do that, what would they want to do at this point?
Yeah. Yeah. And I don't know. I mean, it's complex. I mean, you can argue that the US has done a lot better than other countries. I mean, I would argue that's probably in large part just because the private sector is so healthy and vibrant right now. But yeah, I mean, I don't know. The political situation in this country is a disaster and seems to be getting worse and worse every single day. So I don't know. It's probably best not to even talk about it.
Yeah, that's probably true. We should probably stay away from that. So we'll move on to your one-man investment committee, which has approved another rule here, the modified Roche rule. So you've got two actually, which puts you above a lot of other people. What is this rule?
So this is an alternative, or there's all sorts of alternative versions of the Taylor rule. And basically I created this back in 2016 because there's a lot of criticisms of the Taylor rule. And my biggest criticism is that it can create these sort of like extreme moves in the way that the rule actually would dictate policy, which to me almost negate the effectiveness of a systematic rule when you've got these bands that allow the rule to create these really extreme measurement readings. And so it's an alternative that sort of throttles the rule a little bit. I actually liked it. This chart doesn't actually show it, but I actually would, if it was my preferred way of running it, I would basically create a lower bound and an upper bound of the Fed funds rate where, for instance, if on the lower bound, it's kind of well known in economics that 0% is kind of the natural lower bound. So you shouldn't go below 0 probably. And then in terms of like a modified rule, like I like the idea that the absolute like peak of a Fed funds rate should probably be something like 5%. So you actually create, you would use this rule, but you would actually create an upper and lower bound within the rule where you sort of throttle how much the Fed funds rate can actually move, because I think there's certain periods where, let's say, for instance, you had very, very high inflation, say 20%, you were sort of like a Turkey or an Argentina or something like that. There's a certain threshold where a very, very high interest rate simply does not have any effectiveness and could actually be so high that it's detrimental, that the interest payments on that are so high that it's almost counterproductive. And so creating this sort of upper and lower bound sort of throttles the way that the interest rate can actually impact the economy. And the basic thinking there is hey, when you've got if you've got an inflation rate that is so high that a 5% overnight rate is not sufficient to bring it down, you need to be doing something else. And so that kind of goes back to our point here that, we had a high enough rate of inflation here that even having a 5% overnight rate has not been sufficient to bring inflation down very effectively, which should be telling policymakers, hey, we need to be doing something else. And in this case, it should have probably been reducing the deficit more, less government spending, and more countercyclical policies outside of the interest rate variable. Because that's the other thing. The interest rate variable is just famously blunt. And so its imprecision is very well known. And it makes sense to force policymakers to think outside the box at other things and not just have the Fed, running this ship all alone.
So as we close, we've been asking the same standard closing question to everybody today. That question is, what is one interesting thing you're seeing right now that you think other people should be paying more attention to? And it could be inside investing or outside investing.
Yeah, I mean, this is just front and center for me, and it kind of goes with the whole theme of the day. I think that our time here is so limited. I've gotten hyper focused on thinking about things across time horizons, and we've talked in the past, Jack, about my concept of defined duration investing, but I think this is useful for a lot of different aspects of life. I like thinking about investing not just across, diversifying across asset classes, but I think it can be really useful for people to think about diversifying across time horizons. It's something that, we don't talk about enough, and I think part of that is that it's hard to quantify, say, the time horizon of things like the stock market or, even certain, types of contracts that we use in finance that don't have a defined duration or a defined maturity time horizon. And, I try to steer people to think of their diversified portfolio, not just across diversification of asset classes, but diversification across time, because ultimately time is the thing that we're all trying to navigate here. And the greater that you can create clarity across time horizons, I think the better you'll perform financially and behaviorally. And, going back to the whole estate planning concept, I mean, that's all temporal control. Buying life insurance is getting temporal control. Having an estate plan is having certainty of time horizons across, succession planning and, the beneficiaries and the way they're going to navigate things. And so, don't just think about diversification across asset classes and, the sort of traditional metrics that a lot of us talk about, but try to focus more across time horizons, because especially, we're all kind of getting to the point where we're becoming old men, and, that temporal uncertainty kind of lops you over the head, and you wake up one day and you realize you're an old POS, and you got to start thinking about, multi-temporal time horizons.
Mike Taylor this morning told me I'm going to live forever, so I feel all right.
Oh, that's right. Yeah. those that's come fast enough for us. Well,
Somehow, yeah. Hey, we're all going to be robots, and we're all going to have a Neuralink and a robot, a Cullen robot that it becomes the one-man investment committee. So,
well, thank you so much, Cullen. This is great. Thank you for joining us.
Thank you, guys.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbono. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Lydia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Lydia Capital.